Investors, hope you're all doing well out there. It's been a crazy couple of weeks in the stock market. The S&P 500 has been hitting all-time highs. We've had Meta stock just shoot up to the moon like a rocket ship. They had great earnings. They announced a dividend. They announced share buybacks. So what I wanted to do in today's video was just do a quick update of my portfolio, kind of come back down to reality, see the changes that I've made in my portfolio, and then we'll look at how my portfolio has fared in performance relative to the S&P 500. So if that's some content you would be interested in watching, I encourage you to watch a video, and if you like it, give it a thumbs up. So without further ado, let's go and dive right into the portfolio review. So this is my investment portfolio tracking spreadsheet. If you see my channel, you should be familiar with it. We're going to go and look at the relevant sections. So here we're going to be looking at the sector allocation first, and I will make this a little bit bigger so you can see. All right, so the largest portion or sector of my portfolio is invested into technology at about 17%. Next, we have cash. So this is about 16% of my portfolio, and this is one of the changes that I currently made. So as valuations started to rise, and again, they're at the high end of their valuations for a lot of the companies that I own, I decided to take some profits off the table, lock in some gains, and I also switched brokers. So I switched from Wealthsimple to IBKR or Interactive Brokers because they had lower commissions on US stocks. So I had to sell off some of those fractional shares that I held with Wealthsimple. Again, I wasn't too fussed about this because I had some great gains in these companies. And like I said, they're trading at the higher end of their valuation ranges. So I feel fine locking in the profits and having this additional cash to bolster my cash position for future opportunities. So this cash is split between 10% roughly in the US and 5 or 6% in Canadian funds. Next, we have alternative asset management making up about 13% of my portfolio. We have real estate at about 11%, payment processing at 10%, railroads at 10%, consumer discretionary at 8%, US banks at 7%, and Canadian banks at 5%. So let's go and look at those stocks in detail. I'll make this a little bit bigger for you as well. So as you can see, Microsoft is still my largest individual position. They had earnings come out this past couple of weeks, and they were great cloud growth. Again, roughly was it 30% year over year. So great cloud growth, great products. I'm very bullish on Microsoft for the future. Brookfield Corporation and Brookfield Asset Management together, they make up 13% of my portfolio, and they are again still undervalued in my opinion, especially the corporation. So I've been buying large shares of Brookfield Corporation as opportunity presents itself over the past couple of weeks, and I'll continue buying Brookfield Corporation as I see fit. American Express makes up about 6% of my portfolio. They had a great earnings report in my opinion. They guided to great future earnings for the next year and long-term earnings per share growth. So they had great earnings. This used to be a 5% position. It's actually gone up because of the gains that I've seen from this position. And I'm still holding this one for the long term because I still think it's reasonably valued. I don't think it's overvalued. It's not really as undervalued as it was before. It's still fairly valued in my opinion. And they have great growth metrics along with great dividend growth. They increased their dividend by 17%. So I'm holding this one for the long term. Next, we have CP Rail. They also came out with earnings. They're a little bit mixed, but it's going to take some time for those synergies from that acquisition that they made to come through. So I'm holding CP Rail for the long term. Apple, they released earnings this past week. They had okay revenue growth, roughly 2 or 3% on the top line, and then earnings per share growth coming in as expected or a little bit higher. Apple is one of these companies where I can't let it go, even though they're not growing as high as their valuation states or might suggest. I just believe that they're one of these companies because they have this whole monopoly on our phones and other technology and this whole ecosystem. They're going to continue to find ways to monetize this and having this huge active installed user base. I believe that they're going to come out with a couple of new products or services in the future that are going to be essential for our daily lives. Next, we have JP Morgan, the best bank in the world, at about 5%. I'm holding this one for the long term. So Visa here makes up about 4% of this portfolio. I had to sell some fractional shares of my Visa when I did do this transfer because this was roughly about 4.5% of my portfolio. And I would like to get this position to roughly at least a 5% position moving forward. Again, I'm happy or okay taking those gains because it is on the high end of its valuation range. But I do want to bolster this position back up to roughly at least a 5% position. Even if it was 6 or 7, I'd probably be okay with that. It's one of these quality companies that I think is just one of the best companies I've ever seen. But like I said, it's at the high end of its valuation range. It makes about 4% of this portfolio, and I'm okay with that for now. Then we have the REITs, so Vici Property, Agri Realty, and then we have Realty Income here as well. Again, these are kind of the laggards here compared to the higher flying technology companies like Microsoft and Apple. They've kind of been lagging because the interest rates are still, having that negative connotation or that negative effect of bringing the valuation of their assets and increasing the higher debt payments or interest payments that they have to make. But I believe once interest rates start to come down or normalize, these companies will see great stock price appreciation along with dividend growth. Then we have Costco. Costco making up about 3.3% of my portfolio. Used to make up almost 4%, and I did have to sell a fractional share of Costco when I did that transfer. But it's trading at the super high end of its valuation range. Again, with Costco, you can say that at any time. It's always trading at a premium valuation. It's actually been my largest gainer in my portfolio. It has the highest percentage gain. I think it's roughly 60%, which we'll look at in a minute. But again, it's one of these companies where I want a larger position, same as Visa. Like I want a larger position in both Visa and Costco, but the price is too expensive right now. I am not willing to forego valuation in terms of trying to buy my Costco shares. I'm going to be patient and wait for a significant dip or a significant stock price decline before I add more shares of Costco. And again, if I can get this up to a 5 or 6% position, I would be very happy with that. Then we have Lowe's, and we can look at that with Home Depot as well. Again, the duopoly here in the home improvement and home renovation sector. I'm just holding these for the long term. TD Bank. So TD Bank, I've decreased my position in roughly 3% of this portfolio. I'm holding it. I'm happy with it. Again, the interest rates have had a negative impact on the big 6 banks in Canada, but I'm holding it because as these interest rates come down, and a lot of these provisions for credit losses that these banks have, basically made the provisions for, once those do not come to fruition or realization and they flow back into the income statement, I think these stocks are going to be great potential gainers in the future. So I'm holding on to my shares, and they're paying me a great dividend. They still have dividend growth, still a monopolistic, oligopolistic company. So I'm holding them for the long term, but they always are a smaller position in my portfolio. National Bank. Same idea here. I'm holding National Bank for those same reasons at about 3% of my portfolio. And then we have Bank of America. It's about 2.5% of my portfolio. I still think it's undervalued. It's where it's trading. Again, I'm up about 20% here on Bank of America. I still believe that's undervalued, and when interest rate cuts happen, I believe the valuations on these banks are going to increase. Then we have UNP and CNI or CNR. I could have looked at this again with CP Rail. I'm holding these railways for the long term. I think these railways are going to have great synergies in the future. They're going to continue to produce huge amounts of cash flow and reward shareholders in terms of dividends and share buybacks. Then we have Google here. So Google here makes about 1% of my portfolio. It is the smallest position. I do want to add to my Google position, make it roughly maybe a 3 or 4% of my portfolio, but I need to wait for these valuations to come down. It's still trading at the high end of its valuation along with the other tech companies. And again, with the other Magnificent Seven, as people call them. It's just too highly valuated or richly valuated, in my opinion. I'm going to wait until these prices come down and be patient with my stocks. Then we have my cash positions, again, split between my US cash, at 10%, and then about 6% in Canadian cash. So that was these stocks in my portfolio. Now we can go and look at the gains and losses of each of these, and I'll make this a little bit bigger as well. All right, so as you can see, Costco, I'm up 65%. It's my largest position in terms of a gain. So it is my highest gainer, but again, I do kind of regret not going higher or going more heavy into Costco. When I went in, I made it a smaller position because back then I thought it was still pretty richly valued, and it's just continued to go up. So one lesson that I've learned is when I have a conviction in a stock or a business and it's trading at a reasonable valuation, I need to pull the trigger. I need to go more heavily into that company. So if Costco ever does go down again, I will start buying heavily. Then we have Microsoft, nice 56% here. JP Morgan at 53% that I'm up. And then the payment processors, American Express and Visa, I'm up about 40% on each. So again, great businesses. So these businesses here, and in terms of all my holdings, they're all basically up roughly anywhere from 15, 20, or 30%. The real companies here that are causing a drag on my portfolio are TD Bank, ADC, Vici Properties, and then OM up a little bit as well. But the REITs and the banks. So again, as these interest rates remain high, they are causing the stocks of these companies, because they are affected highly by interest rates, to remain depressed. So I don't believe that's going to be the trend going forward. As interest rate cuts come, these businesses and their valuations will then start to resume their normal level and increase in stock or share price appreciation along with dividend growth. So I'm holding these for the long term. So let's go and look at what that looks like in terms of my book value and my market value. So as you can see, I'm up about 20%, 20.5%. Current dividend yield is 1.77%. So not a lot of dividend income coming from this portfolio, but more dividend growth. Annually, that provides me with about $1,000 of dividend income. And when we look at it, this portfolio has a market value of $59,000, and I'm up about $10,000 there. So let's go and look at the portfolio and how it has performed against the S&P 500. So if you've been watching the S&P 500, again, I've pulled up a chart here. Over the past 6 months, it has been on a tear. So from October until now, it's up roughly 20.37%. So that is huge growth there and huge stock price appreciation. So when we look at that, we can see that the S&P 500, again, when you're looking at a 5-year period, like it's hitting all-time highs. And the reason for this is these magnificent seven, and companies like Meta. Like Meta was trading at 179 a year ago. It's all the way up to 474. And again, when you look at it, that's about 165% return over 1 year. Now, Meta makes up a decent amount of the S&P 500, along with Microsoft, Apple, Nvidia, Amazon. Again, these companies have been having huge years and huge returns. So that has had an effect on my portfolio. Like we saw, I do have some tech companies like Microsoft and Apple, but I do not have all of these tech companies in my portfolio. I have other types of companies. I have consumer discretionary, I have REITs, I have banks, I have all of these type of different companies that do not move in the same magnitude as these magnificent seven did. So I did expect my portfolio to actually be close to the performance of the S&P 500 because of how well it has performed. So what I've done is I've taken the performance benchmark and I've taken the S&P 500's price. Now, if I had, when I started this portfolio in April 1st, 2022, and dollar costed average in, I just use an arbitrary amount, but again, any amount would yield you the same result. And if I put money in on the first of every single day of each of these months, like I plan to, instead of investing how I did by selecting my companies and doing that, compared to dollar cost averaging into the S&P 500 as shown here, we can see that I actually outperformed by about 2.88%. So I'm outperforming by almost 3% here. Now, I did have a way higher margin of outperformance. It was closer to 10% when it was about last month when this was happening. But because the stock prices have surged so much over the past couple of months, my outperformance margin has actually slipped from 10% to about 3%. So that is very key. Now, am I worried about this? I am not worried about this. These stock price appreciations and the S&P 500 hitting all-time highs, again, it's great, but valuations are stretched in my opinion. I am looking at my portfolio for the long term. I'm still outperforming by 3%, which is great, but I need to keep cognizant of the fact that maybe the S&P 500 might outperform me in the short term. My goal is long-term outperformance. So I want to keep cognizant of this fact. Maybe the S&P 500 will outperform my portfolio. Maybe it won't. Maybe it will in the short term or the long term. I'm not sure. But the way that I've built my portfolio is to try to outperform the S&P 500 by about anywhere from 1 to 3 or 4% a year, and I think that will compound over time. I still think that the S&P 500 is overvalued, and again, markets can remain irrational longer than I think or than you think, but I think that I'm going to stay with my portfolio methodology and continue to invest in these companies even though the S&P 500 has almost caught up to my performance. Again, if you have any comments or questions on how I'm doing my portfolio, I encourage you to leave those in the comments section below, and I'm glad to look at those and comment on those as well. And this is one of those theories that I'm testing. Can I beat the S&P 500 over time? Looking at it, I was doing a pretty good job. I was up about 10% a couple of months ago, but because of the large move of these technology companies, that's cut down my margin to about 3%. But like I said, I hold a lot of different companies in different industries. Who's to say that there's not a sector rotation out of technology and a sector rotation back into high quality dividend paying stocks? We won't know. We'll just have to see and wait for the future. So that was my portfolio update. I hope you enjoyed it, and I will see you in the next video. Thanks. Have a good one. Please note I am not a financial advisor by any means. All this information was merely for your entertainment purposes only. Please do your own due diligence when investing. Investing is inherently risky and you can lose money. I am not responsible or liable for any investing decisions or losses you may incur. Thank you. Have a great day.